presentation is titled Australia's Role in Shaping the Precious Metals Market in APAC. May I invite Mr. Jordan Eliseo, General Manager, ABC Bullion, to come on stage and deliver his presentation.
Thank you for the warm introduction and for the invitation to present today. It's my first time coming to this fantastic conference, so a huge honour to be able to share some time with you and address this topic around Australia's role in shaping up the Asia-Pacific precious metal market. And I thought I'd try and address that in, I suppose, two key ways over the course of the next 15 minutes. Start by looking at the most obvious thing, which is the importance of Asian markets as a destination for Australian precious metals and why Australia is so well positioned to benefit from that demand from this region. And then the last three topics really more look at Australia's ability to shape the market here through demand that we actually see onshore within Australia, which is something that I'm obviously very close to given my role at ABC Bullion and our operations across the country. So if we talk about Australian gold going through to Asia and even just the metal that we produce at ABC, essentially you can probably put it into three key buckets, the largest of which is circa 85% of production basically being made into kilobars, the primary destination of which is, of course, Asia through trading hubs like Singapore here, through Hong Kong, other places as well. And then the sort of smaller denomination products, which is the stuff that we tend to see purchased and invested in by consumers and by investors in Australia. And probably not news to anyone, the two or three key reasons why Australian gold is so favourable in this region. Obviously, we have regulatory frameworks that are incredibly supportive of trade in precious metals. Australia has an outstanding reputation for quality and sourcing of precious metals, so a really strong low-cost producer base, world-class production standards, I would say world-leading ESG credentials, and the like. And then, of course, last but not least, it doesn't hurt that the logistics are incredibly favourable around similar time zones, ease of execution, trade settlement, metal movements, etc. But there's probably one last bit that I think sort of helps drive or is an important story to Australia's role shaping the precious metal market. And that's to do with actually the demographic breakdown of the Australian population now. So when I was a high school student in the 1990s, politicians, business leaders and the like always used to refer to the opportunity that Australia had to grow trade relations with Asia, and the phrase that was always used was that Asia was on our doorstep. That was true then, that's true now, it'll obviously be true into the future. But if we look at the Australian population today, I'd argue that it's far more than on our doorstep, it's very much in our living room as well, due to the actual demographic breakdown of the Australian population. So 30% of Australians are born overseas. There's over 1.5 million residents that are of Chinese or Indian background. Indian born citizens are the fastest growing section of inward migration into Australia. And even when you look beyond, I suppose, the big two countries, the other nations that feature quite prominently in terms of inward migration into Australia, Nepal, Philippines, Vietnam, etc., all, I would say, fairly gold-friendly communities, and so that desire for gold has come into Australia as those communities move and really flourish in and amongst Australian society. And that's a sort of a good segue into, I guess, the Australian case for gold and what we see driving investment in Australia. Now, when we look at the case for gold more broadly, really I think there are three distinct buckets or reasons that people tend to look to allocating towards gold. There's obviously the return angle, there's its diversification benefits, and there's of course liquidity concerns or its liquidity profile. I'm only going to deal with those last two, largely because the return argument for an Australian investor over the long run at least is broadly the same as what it is in most other parts of the world. But there's some interesting points around the diversification and the liquidity angle that are particularly relevant for Australian investors. So when we start with diversification, gold's ability to protect portfolios when it's needed most, Australian gold really comes into its own. So the chart that we're looking at behind me now, sourced from World Gold Council data, it looks at the performance of gold both in US dollars as well as in Australian dollars in 7 or 8 of the largest risk-off environments that we've seen in markets dating back to the dot-com bust almost 25 years ago. And you can see very clearly that, so the purplish line is the US dollar gold price, the lightish gold line is the Australian dollar gold price. And you can see that the return of gold in US dollars has been very favourable in almost all environments, and the average across these environments or periods as a whole was about 10%. The return for Australian investors was double that, on average close to 20% in these periods. So Australian investors benefit from gold as a diversifier and as a wealth protector in risk-off periods. One, because it's gold and it tends to do well irrespective of the currency, but two, because of the effectively additional bang for our buck that we get with the traditional weakness we see in the Australian currency whenever there are risk-off periods. Now, there's a second component to this, and there's a bit of an interplay between them, which is also to do with the liquidity of Australian investment portfolios and really the ability that gold has going forward. So if you look at this table behind me, it looks at the daily turnover of a handful of key asset classes. Again, I've used some World Gold Council data for some of this and then others sourced directly from Australian markets. So, if you look at the bottom, the S&P 500 does about 250 billion in daily turnover. Next up is gold itself, around 160, broadly similar to the T-bill market. Then you have a huge drop-off when you start to look at European sovereign debt markets. But when you look at Australia, the numbers are even more minuscule. So in US dollar terms, daily turnover in the Aussie equity market is barely $5 billion, and same for the Australian bond market. So if you're a US institutional investor and you put a significant portion of your wealth into the S&P 500, you've actually got an extremely liquid exposure, as you can see. You've also got a very diversified exposure because the S&P has a really nice broad sector weighting and roughly 40% of its earnings are now generated from overseas investments. The Australian market is not like that. If you buy Australian shares, exposure to the ASX 200, certainly from an institutional investor perspective, it's not that liquid relative to certain alternatives, and it's incredibly concentrated in resources and in financials. So as we sort of move forward, as the market evolves, I think these two elements, this diversification angle, this liquidity angle, have a really distinct Australian flavour that gold can help support and help solve for, if that makes sense. And that's a decent little segue into how Australian investors allocate to gold right now within the country. And on this, I wanted to look at, I suppose, the two distinct parts of the market that we see. So there's the ETF market and then there's physical bars and coins. So if we look at the ETF market, and I've used a US chart here just to start as a comparator, what this chart shows is the share of the US ETF market that is made up by gold ETFs. So if you go back to 2011, the number was almost 8%. So 8% of all ETF assets in the United States were actually gold ETFs. I think at the time, GLD was the largest ETF in the world by assets under management, bigger than any equity product, any fixed income product, you name it. In the subsequent period, obviously gold had a long consolidation, equity markets recovered, and perhaps most importantly, passive investments became the number one way that people began to allocate to capital markets, to listed equities, fixed income, you name it. So it's another way, a long way of saying that the denominator exploded, and that's why we're in a position now where gold ETFs make up about 2% of the US market. It's broadly similar in Australia. So in Australia, there's about $4.5 billion in precious metal ETFs, full stop. So that's excluding gold mining equities, just silver, gold, and PGMs. 80% of that is in gold alone. And that is around 2.5% of the Australian ETF market, based on the current value of all ETFs in Australia. those numbers are expected to grow. The ETF market, given it's regulated, given it's listed, will probably be one of the beneficiaries of any kind of increase in gold demand that we may see onshore in the years to come. And then when we look at the bar and coin market in Australia, and we just sort of break it down into dollars, we can sort of see that 80% of the money tends to flow into gold, so people chasing that or looking for that safe haven, that source of liquidity, that source of diversification, and about 20% of the money tends to go into silver. So, and then even when you look sort of within those two precious metals, the overwhelming majority, up towards 90%, goes into sort of pooled products and cast bars, far less in coins, in minted tablets, in the kind of higher margin stuff and smaller denomination products. So that's how Australian investors allocate. They tend to be fairly discerning. They're obviously looking to minimise transaction costs and the like when they're allocating to this space. As a final section I wanted to talk about, and again we'll sort of loop back in the institutional wealth management space and the potential for growth, is really talking about the outlook for precious metals in Australia and the way that may influence the region, as it were. Australia, one of the areas where it's I suppose a real market leader or globally is in retirement planning and the pools of capital we're building to help citizens enjoy a comfortable retirement. We call that system superannuation in Australia. It's around 11% of everybody's income is forced into a retirement savings product until you actually do retire or meet a condition of release. That market is roughly $3.5 trillion of investable assets today. It is projected to basically triple to about 11 trillion within the next 2 decades. May not quite end up being quite that big. There's obviously always the chance that we see another significant hiccup in risk assets, correction, global recession, you name it, that will obviously give that a little bit of a bump. But there's no doubt that this market is going to continue to grow, and obviously that capital needs to find a home. And as I've addressed already, there are some very, very clear diversification benefits and liquidity benefits that gold can bring. So if we look at this pool of capital growing and we look at, I suppose, the two types of investor that can look at gold, you've sort of got your DIY investor and you've got your institutional investor or your intermediary allocating on behalf of individuals. And I think either way there's a nice story to be told about gold, irrespective of who you're speaking to. So for the DIY investor, apart from the returns, apart from the diversification, apart from the liquidity, you've got a highly accessible asset class. So one of the things that I think sometimes certain people in the investment community don't do very well is they will talk about the rationale behind an investment, which may well be totally right, but if you're talking to people that have no way of accessing that investment, it's kind of pointless. So when you're talking to direct investors in Australia that are managing their own retirement portfolio, they might have $1 million to invest. So if they're going to invest 10 or 15% of their portfolio in precious metals, you're talking $100,000 to $150,000. That's very easy to do. You're not going to go and buy distressed credit or unlisted infrastructure or private equity with those kinds of sums of money. So it's very accessible, it's tangible, it's easy to understand. And whilst there's no income, obviously, from gold or any precious metals for that matter, I think if packaged the right way, it actually can be, especially given its diversification benefits, its negative correlation to equities in risk-off environments, it can be packaged as a complementary source of cash flow through decumulation, which can support retiree lifestyles. Again, that'll probably most likely be expressed through regulated products and the like, rather than directly through bars and coins. And as a final comment, as we move towards or pivot back to institutional investors, one of the things that we have seen, so obviously I talked before about how small the Australian equity market is, how large the pools of capital we have. Institutional investors are aware of this, and indeed over the last 15 years, we've seen a pretty big shift from these investors to begin to, I suppose, chip away at the allocation they have to traditional assets, just straight out fixed income and equities, and move towards a basket of alternatives. Now, there are various ways you can look at institutional superannuation funds in Australia, but if we take them as a whole, the amount of money that they've got in what we call alternatives has gone from about 5% to probably about 22% of total portfolios in the last 20 years. I suspect that may well grow, and I think that provided it's packaged through regulated products with the appropriate liquidity profile, there's a great story for gold there as well, because gold actually stacks up very well against a basket of alternatives. It tends to be much lower cost, it tends to be much higher liquidity, it tends to be far easier to monitor. It has absolutely no dispersion risk at all, which is a real problem within alternatives. And it brings obvious ESG credentials and benefits to a portfolio as well. Ladies and gents, thank you very much.